So I have presented a few strategies, models and portfolios on my channel, and the reason why I study so many of them is not to copy paste the stocks, but it's to get a better idea of the most important levers in stock selection. I learn from it, I then try to apply it in developing my own investing strategy. So I'm always looking around, and that search led me to yet another portfolio selection strategy. This one comes from Ambit Capital, which means it's Atmanirbhar in every possible way. Ambit calls it their 10-bagger portfolio, and to put it in numbers, this portfolio has posted an annualized return of 22% over the last 11 years. So that's like converting 1 into 9 rupees, and in this video we'll understand the framework Ambit follows to identify those 10-bagger stocks. I'll even get into specifics including the formulas and the criteria they use. We'll see how this portfolio has performed over many years, and of course I'll also list down the set of companies that make up this year's 10-bagger portfolio. This video was a lot of work as there isn't much written on this concept, and if you find it useful, then do show your appreciation with a thumbs up, as it will definitely help me with the YouTube algorithm. Let's begin. Ambit Capital first released a 10-bagger portfolio in 2012, and the inaugural edition was compiled by two young analysts, Gaurav Mehta and Saurabh Mukherjea, who have gone on to do bigger things. Now, over the last 11 years, this document has obviously evolved, which is why I'll be referring to the more recent years to get a better understanding of what Ambit refers to as their greatness framework. So as per Ambit, a company's road to greatness is paved with what a company is doing to improve and consistently improve its structural strengths over a period of time. Like in this case, the first driver of strength is of course investment, which comes in the form of incremental capex. In fact, Ambit further defines what incremental capex is, which is an improvement in the capital expenditure to depreciation ratio. Now notice here this formula is being calculated over a 6-year period. That is, Ambit takes the recent 3 years and divides it by the past 3 years, which certainly helps in normalizing the results. As examples, look at companies like Balakrishna Industries, look at Coromandel International, and also Page Industries that have been allocating more funds towards growing their manufacturing capacity, especially in the last 3 years. The second box in the framework addresses how efficiently a firm has translated its investments into sales. Now, when Ambit started this framework in 2012, they used two distinct variables. The asset turnover ratio, whose importance we studied in my video on margin of safety, and they also considered the sales growth. But in recent presentations, Ambit seems to be focusing on just incremental sales, but it also measures the sales growth against its standard deviation to ensure consistency of performance. Again, as examples, look at companies like Deepak Nitrite, Gland Pharma and SRF Limited, who have tremendously increased their sales in the last 3 years, that is FY 2020 to FY 22, as compared to FY 17 to FY 19 period. The third factor in the framework is the efficiency in capital employed, which is measured as an improvement in the capital employed turnover ratio. Now remember, this is not return on capital employed of the company. Instead, this metric is derived by dividing the company's sales by the average capital employed, which gives us the capital employed turnover ratio. The fourth factor is pricing discipline, and very simply we are referring here to the improvement in the PBIT margins. And again, Ambit not only looks at the growth in margins over a 6-year block, but it also looks for consistency by measuring it against the standard deviation. The fifth element is the balance sheet discipline, whose objective is to examine a company's deleverage ratio, that is, how much of the debt equity ratio the company was able to bring down. And the sixth and final factor is the company's cash generation and profitability improvement, which is measured as an increase in the company's cash flow from operations and of course the consistency of it. So these 6 points are the foundational blocks of Ambit Capital's greatness framework, and these are then applied and weighted equally to arrive at a greatness score, as you can see in the screen here. In fact, this is the list of potential 10-bagger companies that Ambit has recently released, and just to connect with what we had learned earlier, let's verify how these numbers stack up in the case of Persistent Systems, which has been given a greatness score of 100% by Ambit Capital. So the last 2 years, that is 2021 and 2022, have been absolutely fantastic for Persistent, and we can see that build up in terms of the company allocating a higher capex, which in turn has resulted in a higher sales number. A growth in sales cyclically gives the company a higher profit, and although the profit margins have remained steady, the company's cash flow from operations has seen a big jump. I guess that's how the greatness framework works. It's like a cycle of deeds, and the more value a company can add at different stages like improving capex, growing sales, higher profit margins, reducing debt, etc., better would be the immediate and the intermediate future of the company. I should also mention here that this greatness framework excludes all financial institutions like banks, NBFCs, insurance companies, etc., and therefore you are likely to see a lot more manufacturing, IT, pharma, and services companies in the 10-bagger list. You can look for more specifics in Ambit's presentations, which I have shared via a link in the video's description. But I hope this framework part is clear to you, and I sincerely believe each of us can use some parts of it in improving our own stock selection methods. Alright, now that we have a framework, let's convert this information that we have into some actionable points. So Ambit's 2023 presentation explains what distinguishes a great company from a good or mediocre company. For instance, a mediocre company would have grown its sales by 8% over the last 3 years, while a great company would have grown it by 15%. Similarly, a mediocre company, you know what, let's not talk about mediocre companies and let's just focus on the great ones. In fact, let's examine the value addition factors, which is another way of saying that if I want to know if company XYZ is going to be a great company in the future, then ideally it should be growing sales and its cash from operations by at least 15%. Its PAT should grow by at least 23% and ROC of 28% and so on. But if you're looking for a shortcut, then here's a list of Ambit's most recent 10-bag ideas. As one can see here, there are 2 separate lists of companies. The first one is within the BSE 500 universe, which are companies that have a market cap of at least 5,000 crores. And the second list is of companies that are beyond the BSE 500, which we often refer to as microcaps. In fact, Ambit's presentation also gives us specifics on their sales growth, their return on capital employed, their accounting scores, which pertains to Ambit's internal fraud and governance checks, and a lot more information. Of course, the proof of the pudding is in the performance, and pleasantly the 10-bagger portfolios have delivered a CAGR of 22% for the BSE 500 picks and an even higher 26% CAGR for the sub-BSE 500 selections. Now, I have to admit what we have learned so far is just one half of the puzzle. What I mean is we have looked at companies which are structurally strong and can probably grow by 10 times over the next few years. But what we have not addressed yet is that crucial question: is now the right time to buy shares in these companies? And thankfully, Ambit's 10-bagger presentation does answer that question for us with an examination of the company's current PE ratio, its price to book ratio, and the EV on EBITDA. The criteria they have used here is pretty elementary. That is, if the current PE ratio, the current PB ratio, and the current EV to EBITDA are below their historical 5-year average, then Ambit's 10-bagger model treats them as cheap and attractively priced. This puts companies like Ultratech, Dr. Reddy's, Gland Pharma, India Mart, CAMS, etc. within the model's good graces, while companies like SRF, Balkrishna Industries, Tata Elxsi, Persistent, and others are deemed to be on the expensive side. Of course, this analysis is as of 10th of February 2023, and if you want more updated numbers, then I request you to add these companies in a watch list and set up price alerts so that you can take appropriate action when required. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips, and stories that I continually post in the community section. When we think of 10 baggers, the initial impression is that there will be a set of stocks that we'll persist with for the next 7, 8, 10, 15 years. And over this time, their stock price would have increased by 10 times. However, within Ambit's greatness framework and over many iterations, it has been observed that only about 35% of the companies continue to qualify over the next 2 years. Of course, this doesn't mean these companies have lost their shine and they can always come back into the list. But I do find this point interesting because this means Ambit's 10-bagger framework is not a fill it and shut it portfolio. Revisions are made every year and investors need to remove or find new diamonds in the dust. In fact, of the 100 odd companies that Ambit's framework has put forth, there have been just 5 consistent 10-baggers. Nestle India, Hindalco Industries, Ambit India, Page Industries and Tata Elxsi. So as investors, we need to do a little work here, but not a lot. And I think it's worth the effort with this 10-bagger portfolio doing better than the BSE 500 ex BFSI index and the top performing flexi cap funds in most years. So to quickly recap, if you want to run this model with some modifications on a standard stock screener, then we are looking at 10 things. Number 1, we want companies which are incrementally increasing their capital expenditure. Secondly, the companies must be showing a growth in sales. Companies that are generating revenue while using their capital efficiently. Number 4, we want firms that are improving their profit margins. 5, companies whose debt equity ratio is coming down. Point 6, and very important, we are looking for companies where the cash flow from operations is increasing along with its profitability. Number 7, every point I have said so far has to be checked for consistency, which means measuring it in 2 blocks of 3 years and factor in the standard deviation. Point 8, the model assumes that whatever dividend one receives from the stock is being reinvested back on the ex-dividend date, so please do that. Number 9 is the accounting check, and don't forget to filter out companies which have corporate governance issues, dodgy auditor reports, or maybe the promoter has pledged a high percentage of shares, etc. And finally, there is point number 10, which says greatness has a price to it. That is, you want to pick those stocks in your 10-bagger portfolio which are attractively valued as compared to their historical valuations. For this, we examine the company's PE ratio, its PB ratio, and the EV to EBITDA to see which stocks can be included in this year's 10-bagger list and which ones might have to be removed. So these are the 10 steps that I think form Ambit Capital's 10-bagger framework. And while these 37 here is what Ambit has identified as companies with formidable strength, I should point out that these should be looked merely as ideas and not as something that Ambit is revealing out of the goodness of their heart. I'm sure when Ambit does stock selection for its paying clients, there are pluses and minuses from this list, but nevertheless, I think this is a good list to work with, especially in developing and nurturing one's own stock portfolio. So go through the presentation that I have attached as a link in the video's description, try out some of the criteria on a stock screener, apply your learnings from my previous videos, especially the ones on Coffee Can, Peter Lynch and the Magic Formula. And if you're happy with everything, then do explore creating a small opportunity portfolio using these principles to test it out in the real world. Once again, thank you for your time. Do like this video, do share it with your friends, and I'll see you 3 days from now. Until then.